Are you looking to sell a put on MSTY or any other stock? How do you know what strike to select? And what expiration date do you select? Stay tuned and I'll give you my thoughts on that. Hello my friends, this is Legend. So we have talked a little bit about when I look to buy shares of MSTY, and we've also just kind of touched a little bit on selling puts on MSTY. We actually went through the options chain and gave a brief little view of what the option chain looks like. So the bigger question is, when you're looking to sell a put, how do you know what put to select? Which strike price do you pick? And what's the expiration date for it? Well, ultimately, it is up to you to do that, to select your strike, to select your expiration date. And it really all depends on what your overall goal and plan is for that put. But I'm just going to quickly go through what I do and how I look to sell puts on MSTY, the strikes that I'm looking for, and when I'm looking to sell a put on MSTY. So let's just slide right over to the Webull chart and get started. So here we are on the Webull chart, and we're looking at MSTY right now. And I've already got the Bollinger Band turned on. I'm hiding all of my lines, supports, and resistance lines that we had drawn in. I'm hiding those because it just gets a little too busy to see. So the first thing you always look for when you're looking to sell a put, you're looking for a stock that you're hoping that goes up over time, because you're looking to purchase shares at a price on a certain date. And why would you want to buy shares of a stock that's going to be going down? So first thing you have to find is a stock that you have conviction on, that you see that this stock is going to continue to go up over time. So we're going to pick MSTY because it uses the underlying of Mr. And Mr. is a Bitcoin play, and I can see Bitcoin continuing to go on up. Therefore, Mr. following that and ultimately pushing MSTY on up. So we're going to look at MSTY right here. And the first thing that I look for outside of a stock that is going up over time, and once I've picked that, the next thing I'm looking for is that candle. Is it between the mid and the lower? That's kind of really where I'm looking for that candle to live at that time that I'm going to be selling that put. And that's only to help me get a better buy price if I was to be assigned those shares. So for MSTY currently, it does not meet that criteria for me. And these are just my opinions and my thoughts on how I am playing MSTY. So I would prefer that candle here to be in this area here. Below the mid, I prefer it to be close to the bottom of the Bollinger Band, but definitely somewhere in the lower half. But for this example, we're going to ignore that part just so that I can show you an example of selling a put on MSTY. The expiration date that I would pick, the premium that I could earn, and the strike that I would pick. Okay? So, again, keeping the fact that it is on the upper half, keeping that out of the picture here, because currently right now I would not sell a put because I would prefer to get it at a better price. I would prefer that candle to be on the lower half so that I can sell my put even further down for protection and earn that premium for selling that put. So let's continue on here, and we will look at this candle here, and we closed at $21.23. Now, when you sell a put, you are stating that you agree to buy those shares at a certain price by a certain date if the current price is below that strike price. And that strike price is a price that you select. And by doing so, you will earn a premium for selling that put. Okay, so I just pulled up a quick little sheet right here, and we're just going to type this in as we go. We know the current price being $21.23. Now we need to know what that expiration date should be. So let's slide right back over to the chart. And we know that today being April the 20th, but this price is actually April the 17th because that is the last day of trading. They were closed on Friday, but will reopen Monday morning on the 21st. But we're going to play this just as if it was a normal trading day. So we'll go to our option chain. We know our current price being $21.23. First thing we want to look at is what's the expiration date. Now, you can do weeklies on MSTY. Not all stocks have weeklies. Some have monthlies, meaning the expiration date is every month. It'd be the third Friday of the month. That's considered a monthly. MSTY has monthlies and weeklies, right? Because it's every week, but you can also play it like a monthly by doing the third Friday of the month. And I like to do the monthly on MSTY, so I would pick the third Friday of the month. Now, you could space these out if you wanted to have 4 puts going at a time. If that's something you wanted to do, you could space it out to where your first one would be May 16th, and then next week you would sell another put and you would make it for May 23rd. And then the following week, you would sell another put and make it for May the 30th and on, right? So therefore, you may have 3 or 4 puts going so that each week you could have one that would be expiring that week. Now, it is a little bit more to keep track of and to keep up with, so I don't suggest to start off doing that. Start off with just one. And for that one, do the third Friday of the month. And that would be considered more of a monthly put. And that's when a lot of the big institutions do their puts and calls as well. So you'll have a lot of volume, open interest, and everything else like that, which helps you get in and out of a trade. So we'll select the third Friday, and that will be May 16th. We'll open that one up. Current price being $21.23. So we got our first line to fill in here, and that would be the expiration date of May 16th of 2025. All right. So what put strike are we looking for? So I'm going to add one other line here, and I'm going to call this one our estimated or calculated put strike. Now that calculated put strike is something just to look at, right? This is a goal or a suggestion. And for that, I like to take the current price and take it times 0.9. So we'll just do a quick little calculation here and hit equals, and we will select that price, and that's the current price, times 0.9. There we go. So current price being $21.23. Our calculated put strike being $19.11. And that is, again, just simply the current price times 0.9 to give us a calculated put strike to start. Now, we can go up or we can go down. If you want to be a little bit more aggressive with that, you can increase that to $20 or something. But if you want to be a little more safe with it, you can bring that down as well. But we do have to look to see, is there any premium that would be paying us at that price? So let's go check that out. Now remember, it's $19.11. All right, so now we're back over on the chart here, May 16th, and we had that $19.11. So we'll look at this $19 right here, and it is a put. So we are on the put side right here, $19, and it has a range of 65 to 90, and the mid being 78. So for selling a $19 put, we could earn $78 for this $19 put. And we can also check out the delta by sliding the charts over here. That 19 put has a delta of 0.31. Now that's the percentage basically of the chance of it being assigned. The smaller the number, the less chance that it has of being assigned, and the larger the number, then of course the more of the chance to be assigned. Now these numbers are dynamic and they will move as the price moves. So just because it says 0.3 now, being basically a 70% chance that this will expire worthless and a 30% chance that you will be assigned, will change as this price changes. So as this price is 21.23, as it gets closer to 19, it will change and it will increase, because the closer to the strike you get, the higher chance you've got at getting assigned. Now that's really the simple way of looking at the delta. There's a little bit more to it, but I think that's about the simplest way of looking at delta. So we know that's a 0.3 delta, and a lot of times I like to look at more closer to a 0.2 delta or a 0.25. So at an 18, we've got a 0.22 delta. So a little less chance of it getting assigned. But by doing that, of course, you will earn less premium. So here, for an $18 put, I can get $55 per contract, because that's 55 cents per share. Each contract is 100 shares, and that's 55 cents times 100 would be $55. So let's go with an $18 put for May 16th, earning $55 or 55 cents per share. And let's punch that in our little sheet. So we've got a put strike, and we're selecting that $18 put strike. And the premium that we're going to earn, we will earn 55 cents per share. And we're going to assume that we're only getting one contract, okay? So each one of these will be times 100, right? So our put strike being $18, how much money would we have to have in our account in order to be able to cover that put? Would be $18 times 100, okay? So $1,800 you would have to have in your account in order to cover the possibility of you being put those shares. How much premium will we earn? Well, again, that's going to be that 55 cents times 100, $55. Now, if assigned those shares, okay, at $18, what are we really getting it at? Well, we pay $18 for it, but we're going to be able to save 55 cents because we earned that in premium. So we can say that the $18 minus the 55 cents means we're actually getting that for $17.45 when you add back in your premium that you've earned. So if you were looking to buy shares, say 100 shares, at the current price of $21.23, because you want to ride this up to the promised land, and it could do that, right? It could hit that 21.23 and just keep on going. But for selling a put, and you can earn $55 and possibly buy it at $18, if it would happen to fall to that point, I would much rather own those shares at 18 versus 21. I'm still going to have 100 shares no matter what, but I would prefer to be able to own them at a lower cost rather than purchasing at a higher cost. Now, maybe the way you play it is you purchase some shares now so that you can possibly capture that movement up, but you can sell a put at the same time just in case if it does drop, and you can grab those shares at a much lower price and get paid to do so. Now, when you are selling a put, you do not own those shares. You are stating that you are willing to purchase those shares at $18. You do not actually own those shares. Therefore, at distribution time, if you just have a put and you do not have any shares, actual owning any shares, you will not earn a distribution, because you do not earn a distribution on a put that you've sold because you do not actually own those shares yet. Now, if you were assigned early those shares, or you were assigned those shares at any point before the distribution or before X date, right? Then yes, you would be able to earn that distribution. But if you still own that put, or you still got that put that you've sold on X date, you will not earn the distribution for those shares or that contract that you have out there because you don't own the shares. But you did earn some money for just selling that put. You earned $55 and you don't even own the shares. And if it does drop, you get them at a much better price. So you can think of earning that premium in a way can be just like earning that distribution. Now, the hotter you play it, as you can see here, the hotter you play it, the more you can make. You know, if you sell at 19, you get $78. A $20 put strike will pay you $125. 21 strike could pay you $190. But now granted, now keep that in mind. You are agreeing to buy those shares at those prices. So no matter what happens, if MSTY drops down to $10 and you've got a put you sold for $21, you will be purchasing those shares at $21, even though the price of the stock is $10. So it will show you as down in the play. Now you did earn $1.90. So in essence, you could say $21 minus the $1.90 would take you to that $19.10 that we had talked about on the last video. So that helps to offset your cost that you have invested into the play. But just always keep in mind, when you sell a put, you're agreeing to buy those shares at that strike. So that is the catch. Now, I'm not saying that's a bad thing, because if you're willing to buy them at 21, 23 right now, why not sell a put at a lower price, earn premium for doing so, and if it gets down to that price, then you own the shares at that point. So to kind of sum it up here, for this one here, again, not taking into account that it is above the midpoint on that Bollinger Band. And the reason I like it on that bottom half is because the price itself wants to head toward the middle of the Bollinger Band. It likes to stay somewhere in the middle. So if I can catch it on the lower end of that Bollinger Band and then sell a put, which would then be outside of that current location of the Bollinger Band, that's just additional support and safety that I'm building into that play. Now, that does not mean that it will not keep on coming down and assign me at those shares, but that is part of the play and part of just selling a put. And that's why you only sell a put on something that you want to go long on. You want to own those shares. So you've got to be okay with buying those shares at that price, no matter what the price is at the time of your expiration. So at the current price of $21.23, with our expiration of May 16th, which that's about a month out, we were looking at that price times 0.9. So we were looking at a calculated strike to look for was around $19.11. We found a put strike at $18, which had a delta of about 0.22. So only 22% of a chance that it could get assigned, which is a low chance. But again, as that price changes, so does that delta. So take that with a grain of salt. The premium that we would earn is $55, 55 cents per share. And if we're assigned our actual average purchase price, subtracting off that 55 cents would be $17.45. So at $17.45, go back to our chart here. Where does that put us on our chart? Well, 1745 puts us about right here, which is just at the top of that bottom of the Bollinger Band. And that's the reason, if I can get it in this lower half, say at 1850, so at 1850, if we punch that in, and we punch in 1850, say the price of the stock is $18.50, then we would be looking for a strike price of about $16.65. And now with the $16.65, we're down here below that Bollinger Band. And I like that because it's got less of a chance to keep on going past. Now that Bollinger Band will adjust to the price. So as that price increases like this, the Bollinger Band will widen out. And as it starts decreasing and starts getting tighter in here, the Bollinger Band will also get tighter. So the Bollinger Band is a lagging indicator, but it is a good indicator to use when you're looking for ideas of when to sell an option, like a put. So I hope that kind of explains a little bit about how I'm looking at my timing for selling the put. So I'm looking at it to be on the bottom half of that Bollinger Band for a stock that I want to own for the long term if need be. And then I'm going to take that price times 0.9 to help calculate a strike to look for. And then I'm going to also check out the delta to see where that stands. And I prefer around about a 0.2 delta so that it has 20% chance of being assigned, but an 80% chance of it not being assigned. But again, do not use that delta as the gospel, because that will change over time and throughout the day as the price changes. So it is only good for really that moment. But again, it's just an indicator to use to help you decide when's the right time, what's the right price to sell your put at. So I think I'm going to wrap it up right there. If you don't mind, please hit the subscribe button and the like button. It'd be much appreciated. And as always, I am not a financial advisor. This is not financial advice. Please do your own due diligence before you get into any stock plays. And until next time, Legend out.